at the moment, if you look at the markets around the world, we're all winners because markets have had a very strong move, and the worst fears of the Brexit scaremongers have clearly not been fulfilled at all. We had a very sharp sell-off in markets for a few days after the Brexit vote. They recovered very quickly. The big winners in the UK have been those companies which either sell overseas or have subsidiaries overseas benefiting from sterling's fall. They've done very well. Some of the losers in the UK have been those companies most exposed to the domestic economy, where there's likely to be some slowdown, there's some considerable uncertainty. So companies like construction, property companies, banks and insurers have been hit because of the further fall in interest rates. But generally speaking, the UK markets have been very good. The FTSE 100 has had a very sharp rise, well above the levels pre-Brexit. That's the leading index of large companies. The more domestically exposed FTSE 250 index, mid-sized companies, fell about 15% in 2 days after the vote. It's now back up to where it was. Within that, winners and losers, as I mentioned, but generally speaking, pretty good environment. As we'd always said, Brexit was not a global systemic event. It was never going to be. It's not big enough. So after a couple of days of nervousness in markets around the world, pretty sharp recovery. And the one big thing that we have seen post-Brexit is that bond yields have fallen significantly and stayed very low because the view is, the received wisdom now is that interest rates are going to be lower for longer, and we're going to see more easing from the big central banks. We've already seen a bit in the last few weeks. And the Fed, the only central bank in the world, in the developed world, that's raising interest rates and likely to raise interest rates, they are deferring any further rate rises. So very significant move in bond markets. There are some losers out of that, most notably pension funds who have got their liabilities revalued upwards as a result. But generally speaking, most of us are winners from that further fall in interest rates. So we actually had a very good month for markets. Global equity markets were up 5% or so, emerging markets more than that. Global government bonds up again, having had a strong June. So we're now in a situation 7 months into the year where equities are up 5%, emerging markets up about 11 or 12%, and government bonds up an extraordinary 13%. So it's proving to be a very good year for investors so far, albeit with some pretty severe bumps on the way. The Bank of England was very early off the starting blocks in the post-Brexit period by saying that it was ready, willing and able to provide a stimulus to the economy through easing monetary policy if necessary. I think the Bank of England might have been too early off the blocks, in all honesty, because it was very difficult to predict quite where the economy would go. What we do know is that there is heightened uncertainty in this period of transition. With the UK coming out of the EU, it's going to be at least a 2-year negotiating period, so there is uncertainty. But the only evidence we've got so far is that has hit the forward indicators and confidence, particularly in businesses. Are they going to invest in the same way that they would? There's been some positive signs, but there's also been quite a number of pretty negative sort of leading indicators and confidence indicators. Today, the Bank of England has reacted to that by actually a pretty bold move in terms of monetary policy. They've cut interest rates, they've actually halved interest rates from 0.5% to 0.25%, indicated they might well go lower later in the year if the data, when it comes in, confirms what these leading indicators are saying, which is that the economy is going to go into a slowdown. They've also increased the asset purchase programme. They're going to be purchasing another £60 billion of government bonds, £10 billion of corporate debt, in the first big move for them. So that's pretty significant. That's going to drive down longer term interest rates, make it cheaper to borrow for companies, government, individuals, provide a stimulus to the economy. So the Bank of England is doing what it can, and intriguingly, I think the other important point is that the new government, and incidentally, the new government was in place very quickly after Brexit. We thought we were going to go through a 2 or 3 month period of a leadership election in the Conservative Party. In the event, it happened in a matter of days. Theresa May has been extremely sure-footed so far. She's a very experienced, quite a tough politician. So I think it was the right choice for the country. There's already been an indication from the government that they're going to ease the fiscal austerity that was planned for the next 4 years. They're not going to have the same tightening targets. And I wouldn't be at all surprised when we get to the budget coming up in November of this year. I think there's going to be some form of fiscal stimulus in the UK. So there's action being taken to support the economy through this transitional period of uncertainty, which is leading to lower growth. Well, I mentioned the fact that the UK was changing its stance in terms of fiscal policy. That is going to happen elsewhere. I think what we're seeing is monetary policy very loose everywhere, but losing its effectiveness. When you get down to the lower bound of interest rates, zero or negative interest rates, what more can you do? Not a lot. You can continue to buy assets, government bonds and so on, but there's a finite supply of those. You could get to helicopter money. Nobody wants to get to that because of its implications for inflation and debt levels and so on. What we're going to see is more fiscal stimulus. We saw that in Japan this month. We saw the Bank of Japan easing a little bit, followed up by the government providing a big new fiscal stimulus package. In yen terms, 28 trillion yen, about 5% of GDP. But intriguingly, the market wasn't terribly impressed because only a small part of that, about a third of that, was earmarked for current year spending. So the market was a bit disappointed the yen actually went up on it, which is an intriguing response, and of course exactly what the administration of the Bank of Japan are trying to reverse. They want the yen to be weaker. But that's an important thing that's going on. Japan has been a weak market this year. It's rallied quite a lot in the last few weeks, but they need to get the yen down to stimulate this economy. It's still only just growing. It's only just growing at about 0.5% a year. They're still in deflationary territory. That's significant. They've got to get that moving. Other areas of significance in the past month. In Europe, the banking system has gone through its second large stress test in the past couple of years. It came out of it sort of okay. Capital is needed to be raised in Italian banks. We've known that for some time. We've talked about it on previous calls. They haven't recognised their non-performing loans in the way that banks in the UK and the US have. That's got to be addressed and capital raised. But I think the more important thing for banks across the euro area is the fact that we now are living with negative interest rates from the ECB, and they're going to be in that territory lower for longer, very damaging to bank profitability. So it's less now about the capital of banks, but more about future profitability. And that's been hitting bank shares pretty hard, down 30% so far this year in Europe. That's a worry. There's a signal there, so we're concerned about that. China has grown in line with targets in the past 6 months or so, about 6.5%, 6.7%. But the structural imbalances remain, the debt levels remain too high, and China's going to have to slow down. So there are risks and there are headwinds there. And then finally, in the US, the data coming out of the US has been sort of mixed. The employment numbers have been strong, some of the leading indicators have been pretty strong, and yet we just recently had a Q2 GDP growth number of only just over 1%, very disappointing. So the Fed remains on hold. They would like to get interest rates up again, we know that. They want to normalise interest rates to whatever level they now regard as normal. It's clearly going to be much lower than it was in the previous cycle. The economy can't sustain those sorts of levels, but they would like to get rates up. But I think the headwinds that they are seeing around the world, together with the fact that most other central banks are in ultra-loose policy mode and easing further, I think the Fed's going to find it very difficult to raise rates. And we have the little issue in November of a presidential election, with a real possibility of Trump winning that election, of course. Is the Fed going to raise rates before then and take a risk? I doubt it. So we might well get through this year, again, with the Fed having done nothing, even though it's wanting to raise rates. All of those things make for a pretty uncertain environment for markets. But on the positive side, we've got continuing very low rates. We've had the oil price falling 20% in the past 6 weeks or so. Positive ultimately for markets, and it hasn't particularly upset markets in the way that it did when the oil price collapsed through last year and early part of this year. And I think ultimately quite good for consumers of all the consumer and businesses. So on the sort of positive side, and we've got these low rates, as I say, and the world economy continues to chug along at sort of 2.5% growth. So I still think we're in a long, extended cycle, one where we're going to get modest growth, not a bad environment for the corporate sector. But there's going to be quite a few bumps on the way, as we've seen this year already, with 2 sharp downward ticks in markets recovered pretty quickly. I think we're going to get more of that, and we're looking to use those sort of periods of downside volatility to add to equity risk in our portfolios, because it's equities that we still see as the best valued asset class. Bonds, quite frankly, at these sorts of levels look very expensive to us, other than in certain areas of credit. To put them in perspective, incidentally, finally on bonds, if you look at developed market government bonds, a huge market in aggregate, about half of that is now trading on negative yields, 75% on yields less than 1%. That's extremely poor value. So that's why we're looking at areas of credit, and as equities still seem to us to be fair value in a long cycle such as the one we're currently in. Well, this year's been interesting. We've had two periods of real sharp downside volatility in markets, and yet here we are looking at some very decent positive returns from most asset classes. In the case of bonds, very big returns. Bonds, we feel, have got to levels, particularly with safe haven government bonds, where yields are very unattractive. Yields of less than 1% across most government bonds offer no protection against any even modest pickup in inflation. So the opportunity in the fixed income sector, we think, is in credit, high yield areas such as that, which entails more risk, of course, but there are still some opportunities. In equity markets, we do think we're in a long cycle here. We've got sluggish but sustainable growth. We've got very low interest rates, ultra loose monetary policy supporting markets, a low oil price. All of that, I think, is conducive to the cycle being extended for several more years. So our message is to stay invested. There are going to be opportunities in equity markets to make decent returns. I'm not talking about double-digit returns, but I think we are in an era where we can get 6-8% returns out of equities over the next few years. So stay invested and use these periods of sharp weakness that we continue to see for whatever reason that comes along to add to risk in portfolios.